Welcome to another Time in Market Deep Dive. Before we get started, just a quick reminder that everything we talk about today is strictly for entertainment purposes. So, always seek professional financial advice before making any moves yourself.
Absolutely. Good to get that out of the way.
Yeah. So usually when you're looking at a company's financial report, it's kind of like, I don't know, looking at a car's speedometer, right? You look
Yeah.
at the earnings per share, you point at the dashboard, and you just say, okay, that's exactly how fast this business is going.
Right. It's supposed to be straightforward.
Exactly. But then you step into the world of Berkshire Hathaway, and suddenly that speedometer is just completely detached from the engine. Like, we're looking at a financial landscape that is incredibly murky, where the official numbers actively disguise what the company is actually worth.
Oh, it is the absolute definition of diagnostic muddy waters. I mean, especially when you factor in their unique accounting structures and that massive investment portfolio.
Yeah.
The numbers on the front page of their earnings release rarely tell the full story.
Which is exactly why today's mission is a full analysis of the ultimate market heavyweight. We're looking right under the hood of Berkshire Hathaway, specifically the accessible Class B shares, ticker symbol BRKB.
And the timing on this deep dive is just incredible.
It really is. I
Yeah.
mean, for you listening, we've got the 2025 earnings that were just released. We have a brand new CEO at the helm for exactly 100 days now. And this is the crazy part. The company is sitting on a record-shattering $381.7 billion pile of cash.
Yeah, that cash pile is just, it's staggering.
Right. So we are going to examine current performance, break down the actual multiples, run through some intrinsic valuation models, and ultimately deliver a buy, hold, or sell verdict.
It's just a massive transitional moment for the company. Warren Buffett stepped back, Greg Abel stepped up, and there's just a lot of noise in the market right now about what this means for the stock moving forward.
So let's start with where the stock is trading right now and how the business actually performed in 2025. Because if you're looking at this stock for your own portfolio, you need that immediate context.
Right, you need the baseline.
Exactly. So as of early January 2026, BRKB is hovering right around $497.88. And looking at the charts, it's sitting just below a very dense cluster of moving averages.
Which is actually a really important technical signal for anyone watching the daily price action.
How so?
Well, think of a moving average like the stock's historical footprint. It smooths out all that daily volatility so you can see the true direction. And right now, the 20-day, 50-day, 100-day, and 200-day average prices have all converged right around that $497 to $500 range.
Okay, but what does that actually mean mechanically? Like, why does a cluster like that even matter?
Basically, it means the stock has hit this dense wall of historical expectations. I mean, buyers and sellers are essentially deadlocked right now.
Oh, interesting.
Yeah, the short-term traders and the long-term investors are all agreeing on this $500 price point, which tells us the stock has been in a period of intense consolidation. It's kind of catching its breath, trying to figure out what this post-bucket era looks like before making its next major move up or down.
And, man, the 2025 earnings certainly added to that debate.
Oh, they definitely did.
Because the fourth quarter and full year numbers are in, and, well, on the surface, they look a bit rough.
Yeah, they did.
Net earnings came in at $66.9 billion, which is a massive drop from the $88.9 billion they did in 2024. And operating earnings, which, measure the actual businesses they run day to day, those were $44.4 billion for the year compared to $47.4 billion the year prior.
Right. And meanwhile, Greg Abel has officially been CEO for 100 days now?
Yeah, and he just completed a $9.7 billion acquisition of Occidental's chemical unit, OxyChem.
Which is, that is a classic old-school Berkshire move right there. OxyChem is a cash-generative industrial asset. It fits perfectly into their existing energy and manufacturing ecosystem. It really shows Abel isn't deviating from the playbook.
But looking at those earnings drops, I have to wonder, it's like inheriting the keys to a championship sports team from the greatest coach of all time, right?
Yeah, that's a good way to put it.
So the first season out, the record is slightly worse. Are market watchers looking at this dip in operating earnings as a sign the car is slowing down, or is this just a routine pit stop while the new driver adjusts the mirrors?
See, that is the million-dollar question. But before we diagnose the engine, we really have to recognize that the speedometer itself is totally broken here.
Wait, broken how?
Well, those headline numbers, the net earnings that dropped from $88 billion to $66 billion, they are incredibly deceiving. Buffett himself has warned investors for years about this in the annual press releases.
Yeah, he always puts that disclaimer in.
Exactly. So to understand if that 497 price tag is actually justified, we absolutely cannot just look at standard GAAP earnings.
Wait, GAAP as in generally accepted accounting principles, like the standardized rules literally every public company has to follow. Why are they misleading here?
Well, because GAAP rules force Berkshire to include unrealized investment gains and losses in their net earnings. So Berkshire owns this massive portfolio of publicly traded stocks, right? Apple, American Express, Bank of America. Under GAAP, if the stock market goes down in a given quarter, Berkshire has to report a massive loss on their income statement, even if they didn't sell a single share.
Hold on, so you're saying if the broader stock market just has a terrible Tuesday, Berkshire has to report a massive loss on paper, even if the actual businesses they own, like the railroads, the energy grid, the insurance companies, are pumping out record cash?
Exactly. And conversely, if the market spikes, they report massive phantom gains. I mean, Buffett literally calls this net earnings figure meaningless because it completely obscures the actual operating performance of the underlying businesses.
Wow, that seems like a massive flaw in the accounting, especially for a company structured like Berkshire. So if the official numbers are heavily skewed by market volatility, how do we find the real value? What's the actual horsepower of this engine?
So to find the real value, we have to look at Berkshire's hidden engine. And that requires diving into two specific things: the float-first method and their adjusted earnings base.
The float-first method. Okay, let's unpack that, because I feel like float is the secret sauce everyone talks about in finance circles, but very few people actually explain how it works.
Oh, the mechanism is actually brilliant in its simplicity. Float is just the money an insurance company collects in premiums today, but hasn't paid out in claims yet.
Okay, makes sense.
So think about your auto insurance. You pay your premium every month, but you might not get into an accident for, say, 5 years. During that 5-year gap, the insurance company gets to hold your money. And for Berkshire Hathaway, their float grew to an astonishing $176 billion in 2025.
Wait, $176 billion. So it's essentially a massive $176 billion loan that comes with a 0% interest rate, and Berkshire just uses it to invest in other things.
It actually gets even better than that.
How is that possible?
Because Berkshire's insurance underwriting is generally profitable, meaning they actually take in more in premiums than they ever pay out in claims. They're literally being paid to hold that money.
Oh, wow.
Yeah, it's a negative interest rate loan. And historically, they have invested that float brilliantly. Over a 20-year period, Berkshire earned an average of 12.2% per year on this float.
That is wild. They get paid to hold other people's money, and then they make double-digit returns investing it. So how does that factor into the actual earnings we should use to value the company today?
Well, this is where we look at a detailed analysis by Sven Carlin to find Berkshire's true earnings base. Carlin breaks it down by looking completely past the GAAP rules.
Okay, what's his method?
First, you take the earnings from their fully owned businesses. These are the operations they control 100%: Geico Insurance, the BNSF Railroads, Berkshire Hathaway Energy, and all the manufacturing stuff. That gives us roughly $20 billion in baseline cash flow.
Okay, so $20 billion. But as we said earlier, Berkshire also owns huge chunks of public companies.
Right. And here's where standard accounting fails us for the second time. When Berkshire owns, say, 9% of Coca-Cola, standard accounting only allows them to report the dividends they receive from Coca-Cola as income.
Just the dividends.
Exactly. They are not allowed to report their 9% share of the earnings Coca-Cola kept and reinvested in itself.
Oh, I see. So let me get this straight. If Coca-Cola makes $1 billion, pays out half in dividends, and keeps the other half to build new factories, Berkshire only gets to claim the dividend part on their income statement.
Precisely. But that retained cash still belongs to Berkshire's share of the business. Coca-Cola uses that money to build new factories, which makes Berkshire's 9% slice of Coca-Cola more valuable over time.
Right.
Standard accounting is essentially missing a massive chunk of the engine's horsepower because it just ignores this retained cash.
So it's almost like standard accounting is missing a third of the engine entirely. We have to find those missing cylinders.
Yes, and Carlin did the math here. He calculated the payout ratios for all of Berkshire's equity positions and found that there is $11 billion in non-reported retained earnings.
$11 billion.
Yeah. This is cash sitting on the balance sheets of the companies Berkshire owns, generating roughly a 20% return on net tangible equity.
So if we take the $20 million from the fully owned businesses and we add the $11 billion in hidden non-reported earnings, we get a true adjusted free cash flow base of roughly $31 billion.
Exactly. That $31 billion is the actual unvarnished cash-generating power of the Berkshire engine.
Okay, so we've essentially found $11 billion in quote-unquote missing money. But having a massive engine doesn't really matter if you overpay for the car, right?
Right. Valuation is everything.
So how does that $31 billion base actually translate to what the stock is worth today? Because if you look it up on a stock screener right now, the forward price to earnings ratio, the PE, looks to be around 20, which is, pretty standard, maybe even a little expensive for a mature industrial company.
It looks completely different when you use the real numbers, though.
How so?
When you take their market capitalization, subtract the $100+ billion in excess cash they are holding, obviously keeping a little aside for insurance reserves, and then apply that $31 billion adjusted earnings base, the forward PE drops massively.
Down to what?
It falls from 20 all the way down to 11.6.
Oh,
Or even 11, depending on the exact daily price fluctuations.
wow. An adjusted PE of 11 for a company with this kind of fortress balance sheet, that is incredibly cheap.
It really is. And Carlin adds another layer of value to this, too. If you look purely at the equity holdings inside Berkshire, stripping out legacy holdings like Coca-Cola and American Express to look at the broader portfolio, the average PE of the stocks they own is just 10.
Just 10.
Yeah, so you are basically buying a collection of underlying businesses trading at a PE of 10, wrapped inside a massive holding company trading at an adjusted PE of 11.
Okay, so the multiples look great when you adjust them, but let's apply that $31 billion base to a discounted cash flow or DCF analysis to see what the intrinsic value of this company is over the next decade.
Let's do it.
And just for you listening, a DCF is basically a mathematical model that tries to figure out what all the future cash a company will ever make is worth in today's dollars.
Exactly. So using our $31 billion base and applying a very conservative 7% growth rate over the next 10 years, the final intrinsic value heavily depends on your discount rate.
Right.
And the discount rate is essentially the rate of return you demand as an investor for taking on the risk.
See, I always find discount rates a bit abstract. Can you explain mechanically why tweaking that 1% changes the valuation so wildly?
Sure. Think of the discount rate like gravity on your future money.
Gravity.
Yeah. If you demand a 15% annual return, which is high gravity, all those billions of dollars Berkshire will make in the year 2035 are pulled down heavily, making them worth very little to you today. So under a 15% discount rate, BRK is not a great bet at its current price. It simply won't grow fast enough to meet that hurdle.
So high gravity shrinks the present value.
Exactly. But if you lower the gravity, say you use a 7% expected return, the stock is fairly valued right now. You get exactly what you pay for.
Okay, but what if we look at it from the perspective of current government interest rates? Because Carlin modeled a scenario using a discount rate based on the 10-year Treasury yield plus a standard 2% equity premium.
Right, he did.
And that came out to a very low gravity rate of 3.59%.
And if you use that 3.59% discount rate, the intrinsic value absolutely explodes. I mean, the future cash isn't weighed down almost at all. Under that scenario, the intrinsic value of Berkshire reaches $570 billion by 2030, which makes it an extreme bargain today. Oh, wow. Furthermore, we have data from Simply Walsh's independent DCF model, and their model implies that at current prices, BRKB is trading approximately 36.4% below its calculated fair value.
That's like looking at a house listing where the square footage doesn't include a fully finished basement.
That's a great way to look at it.
But I do have to push back here. Who on earth is satisfied with a 3.59% return when inflation eats most of that? Aren't these DCF models dangerously sensitive? Like if we tweak the gravity just a few points, we go from extreme bargain to overpriced. How is an everyday investor supposed to anchor to a real value when the math is that volatile?
Honestly, that is the fatal flaw of relying solely on a DCF model. It's just a calculator, right? It is only as good as the assumptions you type into it.
Exactly.
A 3.59% rate is arguably too low for an equity investor taking on stock market risk. But the takeaway here isn't the exact dollar figure. The takeaway is the realization that when you adjust for the hidden earnings, the margin of safety is much, much wider than the headline JAP numbers suggest.
Okay, so the underlying math, depending on how you slice it, suggests the stock is undervalued potentially by up to 36.4%.
Yes.
But here's the plot twist. The math looks good, but Buffett's own recent actions might be flashing a massive neon warning sign to anyone eager to buy.
Yeah. We really have to talk about the psychological weight of the cash hoard.
Berkshire is sitting on an unprecedented $381.7 billion in cash and short-term equivalents. I mean, to put that in perspective, Buffett has been a net seller of stocks for 12 consecutive quarters.
12 quarters.
In the fourth quarter alone, he pared back Apple by 10 million shares. He slashed their Amazon position by 77%, and he sold over 50 million shares of Bank of America.
And remember, Buffett's famous quote is that his favorite holding period is forever.
Right.
So when the guy who literally wrote the book on buy and hold investing is actively dumping billions of dollars of his favorite stocks to sit on cash, yielding basic treasury rates. What does that tell you?
I mean, it tells me he thinks everything is way too expensive. But why now?
Well, look at the broader macroeconomic picture. The market is incredibly expensive by historical standards right now. The Shiller KP ratio is currently sitting at 39.42.
And for those unfamiliar, the KPD ratio measures the stock market's price relative to 10 years of inflation-adjusted earnings.
Right, so mechanically, a KPE of 39 means you are paying almost 40 years' worth of historical corporate earnings just to buy a piece of the market today.
Which is insane.
Totally insane. The only other time in history it has been higher was during the absolute peak of the dot-com bubble in 2000. So this $381 billion cash hoard strongly suggests Buffett thinks the broader market is significantly overvalued. He is stacking chips, waiting for a crash to deploy that capital at bargain prices.
So if Berkshire is accumulating cash like a squirrel prepping for a nuclear winter, should you, the everyday investor, take that as a warning sign for your own portfolio?
It's definitely something to consider.
And this leads to an even bigger debate. If Berkshire is just holding the same blue chip stocks as the S&P 500 plus a mountain of cash, why bother buying it? Like, if you're listening right now and you hold an S&P 500 index fund in your 401k, why would you buy Berkshire if it's basically offering the exact same returns but with way more concentration risk?
That is exactly the argument made by the analysts at Discipline Funds, and it really challenges the core mythology of the company.
What do they point out?
They note that 50 years ago, Berkshire crushed the market because it acted like a concentrated, nimble private equity firm. Buffett was buying small, undervalued businesses outright. But today, Berkshire is a victim of its own massive size. It takes billions of dollars to even move the needle.
So how does their performance actually stack up against the broader market recently?
Over the last decade, Berkshire's performance is virtually indistinguishable from the S&P 500. It only beat the index by 1% over the last 10 years.
Just 1%.
Yeah.
That completely shatters the illusion that this is a magical wealth-building machine in the modern era. It's essentially a glorified, bloated mutual fund at this point.
It is a harsh reality. And Discipline Funds points out that by owning Berkshire instead of an S&P 500 index fund, you are taking on two massive risks that you just don't get with an index fund.
Which are?
First, you have significant key man risk. For decades, you were betting on Buffett's genius. Now you are betting on Greg Abel's ability to navigate a transition while sitting on $381 billion. That's a huge unknown.
And the second risk?
Heavy concentration risk. An S&P 500 fund gives you 500 companies. Berkshire's top 5 public holdings make up 70% of its equity portfolio.
Wow, 70%.
Yeah, and Apple alone, even after all the recent sales, is still over 22% of the portfolio.
So you really have to ask yourself, are you comfortable having almost a quarter of your equity exposure tied to a single consumer electronics company when you could just buy the broader index and sleep soundly?
Exactly. The risk profile today is completely different than it was in the 1980s or 90s.
So let's bring all of these conflicting signals together. We've analyzed the underlying cash flows, finding the hidden retained earnings to adjust the true PE down to 11. We've run the DCF valuations, showing the stock could be trading at a 36.4% discount to its intrinsic value.
Right.
But we are also staring down the macro warning signs of a $381.7 billion cash hoard, a sky-high Shiller KPE ratio, and the stark reality that Berkshire is struggling to significantly outpace a basic S&P 500 index fund.
It's a lot to weigh.
So synthesizing all the data from our sources, what is the analyst sentiment right now, and what is our final verdict?
Well, despite the very real concerns about size and concentration, current analyst sentiment remains surprisingly bullish. The consensus 12-month target on investing.com is $528.70, which implies moderate upside from the current $497 level.
Okay, so bullish.
Very. And stock analysis features a single analyst 12-month target of $595, paired with a strong buy rating.
Okay, so based on its current discount or premium to calculated intrinsic value, what is the final buy, hold, or sell verdict?
Because the stock is demonstrably trading at a discount to its intrinsic value, up to 36.4% below fair value per selling,
Makes sense.
the final verdict leans heavily toward buy or hold, strictly depending on your personal timeline and goals.
Break that down for us. Who exactly is this a buy for?
It is a buy if you want a reliable 7% long-term compounder that is specifically engineered to outperform during volatile bear market cycles. If you align with traditional value investing, if you fear a market crash based on that Shiller KP ratio, and you want a fortress of a balance sheet protecting your money while the rest of the market burns, it's a buy.
Got it. And who is it a hold or a pass for?
Is a hold or a pass if your portfolio math requires a 15% annualized return. Berkshire is simply too massive to grow at that rate anymore. The laws of financial physics just won't allow it.
Too much gravity, right?
Exactly, too much gravity. It's also a pass if you prefer the pure, decentralized diversification of an S&P 500 index fund, and you want to avoid the concentration risks of having 70% of your equity tied up in just 5 stocks under a brand new CEO.
So the final scorecard is in. Berkshire Hathaway is no longer the get-rich-quick rocket ship of the 1980s, but it is a reinforced submarine built to survive whatever market turbulence or economic winter is coming next.
That is the perfect way to look at it. It won't win a drag race against the tech sector, but it will easily survive a Category 5 economic hurricane.
Let's summarize the journey we just took. We started by looking past the misleading, volatile gap earnings to uncover the true power of the float-first method.
Right, getting past the noise.
By discovering that $11 billion in hidden, non-reported retained earnings, we were able to adjust the P/E ratio down to a highly attractive 11. We ran the DCF models, showing significant undervaluation, but also confronted the glaring warning signs of Buffett's $381.7 billion cash hoard and the stock's recent parity with the S&P 500.
It's a complex picture.
It is. Ultimately, though, the data delivered a buy-hold verdict backed by solid, bullish analyst targets.
And if there's one thing you take away from this analysis, it's that evaluating any stock requires looking past the flashy headline numbers. You have to uncover the actual underlying cash-generating power of the business. You have to find the retained earnings that aren't spelled out in the press release.
Absolutely. You have to check the actual engine, not just the speedometer.
Well said.
But I want to leave you with a final thought to mull over. Warren Buffett always bought businesses with the intention of holding them forever, relying on the quiet, steady power of compounding interest. But with a record cash pile and a brand new CEO finally stepping out of the shadows, you have to wonder.
Yeah, it's a huge question mark.
Will Greg Abel deploy that $381 billion using Buffett's classic, endlessly patient playbook? Or, with the greatest coach of all time finally off the field, are we about to witness a completely new, aggressive era of Berkshire Hathaway acquisitions? Something for you to keep a close eye on as 2026 unfolds. The transition is just beginning.